Observe a modern financial market, and a distinct rhythm emerges. Capital enters, driving prices up in sharp impulse moves, followed by a pullback as the market establishes a new floor. When that reversal hits, traders often rely on a single tool to navigate the volatility: the Fibonacci retracement, a grid of horizontal lines used to identify potential support zones. This diagram shows the grid, with one level at the center. The 50-50 retracement acts as a dominant psychological anchor, where participants expect a bounce. The interface presents this line as integrated. However, it has no mathematical relationship to the rest of the tool. This grouping suggests a shared mathematical origin, yet the logic used to calculate the 50% mark differs from the other ratios. Understanding how these levels function requires separating geometric theory from actual market mechanics. This investigation analyzes the sequence's mathematics, the 50% level's historical origin, and the forces driving price action. Algorithmic trading systems and retail platforms continue to group this heuristic with mathematical constants. Identifying the specific logic behind a tool is necessary to evaluate its effectiveness in a live market. Let's examine the raw mathematics behind the sequence. This diagram illustrates the generation of the Fibonacci sequence. Each number adds the preceding two together, resulting in 1, 2, 3, 5, 8, 13, 21. The underlying ratios emerge when dividing a number by the one immediately before it. 21 divided by 13 converges on 1.618, the golden ratio. Dividing a number by the one that follows it yields 0.618. This is the inverse of phi, and the source of the 61.8% retracement level. Dividing numbers two places apart results in 0.382. But calculate the ratios across the entire infinite sequence. The result is never a clean 0.500. The 50% level does not exist within the Fibonacci sequence, which contradicts its placement within the standard retracement tool. The origin of this metric is found in market observations made over a century ago, before fractal geometry was applied to charts. Charles Dow, the founding editor of the Wall Street Journal, published his conclusions on market behavior between 1900 and 1902. Dow theory notes that primary market trends experience secondary reactions, which we now identify as pullbacks. Analyzing these movements led to the half rule. Dow observed that a market often retraces approximately half of its previous advance before the primary trend continues. This rule of thumb was based on early observations of human market cycles rather than a mathematical law. The 50% level is a product of these early observations and does not share the harmonic structure of the Fibonacci ratios. This observational rule eventually moved into the era of digital charting and algorithmic execution. Modern platforms calculate retracement windows using the highest and lowest prices. When developers designed the code, they included the 0.500 value alongside true Fibonacci ratios. This choice combined Dow theory and Elliott wave theory into a single interface that is now the industry standard. Decades of software design established a persistent association between these two distinct theories. Since the 50% level is an observational heuristic rather than a mathematical sequence, we must examine why price action often reacts at this mark. Market reversals occur when price interacts with concentrated liquidity. Market participants use these levels to organize their orders. This chart displays the limit orders in the market. Liquidity often clusters exactly at the 50% mark. As price reaches this zone, it interacts with the liquidity wall. The absorption of selling pressure results in a rebound. Institutional algorithms and trading bots are often programmed to execute orders at the 50% mark, reinforcing this behavior. This reaction is the result of mechanical order flow rather than a natural harmonic support. The programming of these algorithms reflects the behavioral tendencies of the people who design them. Behavioral finance defines anchoring bias as the tendency to rely on specific reference points. The 50% level is a visually prominent anchor for market participants. When many independent actors anchor to the same coordinate, the collective expectation creates a self-fulfilling prophecy. Support and resistance at 50. The 50% level functions through collective belief, illustrating that human psychology defines these market structures.